Today, for the Series 6 exam, we are covering the critical concept of suitability and customer profiles. This is not just a chapter in the book, it is the ethical and regulatory foundation of your entire career. FINRA Rule 2111 mandates that you must have a reasonable basis to believe a recommendation is suitable for your client based on their specific investment profile. This means you can't just sell the product of the day. You have to play matchmaker between the customer's financial personality and the investment. Let's break down that customer profile. Think of it as having three main pillars. The first is risk tolerance. This is the client's emotional and financial ability to withstand market fluctuations. For a Series 6 exam question, you might see a young professional in their late 20s with a steady job and a goal of long-term growth for retirement. This person likely has a high risk tolerance and can handle the volatility of a growth stock mutual fund. Contrast this with a 70-year-old retiree whose primary objective is capital preservation. Recommending that same growth fund to them would be a major suitability violation. Their low risk tolerance means they should be in something more stable, like a government bond fund or a fixed income investment. The second pillar is the time horizon, which is simply when the client needs the money. This is often the easiest factor to pinpoint, but is critical. If a client tells you they are saving for a down payment on a house in 18 months, their time horizon is short. An equity-based investment, like a mutual fund, is almost always unsuitable because there isn't enough time to recover from a potential market downturn. A money market fund would be a more appropriate recommendation. However, if that same client is saving in a 529 plan for their newborn's college education, they have a long time horizon of about 18 years, making a diversified portfolio of mutual funds a very suitable option. The third pillar is the investment objective. What is the money actually for? The primary objectives you'll see are growth, income, and capital preservation. A client seeking growth wants their principal to appreciate and is willing to take on more risk for higher potential returns. They are a good fit for common stocks and equity mutual funds. A client seeking income needs their investments to generate regular cash flow. Think of a retiree living off their portfolio. You would recommend investments that pay dividends or interest, like corporate bond funds or utility stock funds. Finally, a client focused on capital preservation is most concerned with keeping their principal safe. For them, the most suitable investments are the safest ones, like U.S. Treasury securities. On the exam, you will be tested with scenario-based questions. A common trap is when a client requests an unsuitable investment. For example, a conservative, income-seeking client might ask to buy a speculative sector fund they heard about from a friend. Your duty is not to simply place the order. You must explain the risks and why it doesn't align with their stated objectives. The correct answer will always involve prioritizing the suitability standard over the client's request. To remember these key components when you're under pressure during the exam, use this mental shortcut. Think of the ART of suitability. A stands for age and financial situation. R stands for risk tolerance. T stands for time horizon and objectives. When you read a question, ask yourself if the recommendation fits the client's ART. If it doesn't, it's not a suitable picture and it's the wrong answer. This simple check can help you navigate complex scenarios and choose the most compliant course of action.